Hey everyone, and welcome back. And as promised in today's video, we're going to be taking a deep dive into the GameStop short squeeze that happened in January 2021. To really understand what happened, we're going to go back beyond 2021 to 2020 and even before then to really understand what set up everything that happened. So, for those of you that don't know, GameStop is a brick and mortar gaming store which is known for buying and selling video games. So we're specifically talking about video games and video game specific products. So a lot more specific than brick and mortar places like Best Buy, for example. However, in the modern era, especially during the COVID-19 pandemic, this was considered by most to be a losing business plan. And if we look at the market cap of GME in the previous 5 years, it halved, and the company was considered by most to be the next to go bankrupt. So a far cry from going to the moon. However, that slowly started to change in 2020. So first, in June of 2020, Ryan Cohen, the founder of Chewy, which is an online pet retailer, was announced to be joining the GameStop board. And in September of 2020, it was disclosed that he bought a 10% share in GameStop. And this was pretty significant because, as I mentioned, Chewy is an online specific pet retailer, and it was sold to PetSmart in 2017 for $3.35 billion, which at the time was the largest sale of an e-commerce store ever. So you have a brick and mortar store and business model that is going to be merged with a new chairman whose expertise in e-commerce. Um, this got a lot of people quite excited. And at the time that Ryan Cohen's position was announced in GameStop, it was trading at about $5 per share. Additionally, quickly after that, Michael Burry, who's one of the investors that was made famous by the Big Short for taking a short position on the MBS market, also revealed that he had a 3.3% share in the company. So, coupled with both of these pieces of news in September 2020, you can see that the stock for GameStop started to quickly rise. So you can see pretty much exactly when the Ryan Cohen announcement was made. And between September and December, the value of GameStop and its market cap just tripled. But the big question that was on most investors' minds is why? Because there's still a big problem with GameStop. Its business plan is fundamentally flawed. There's really no need for it. If you think about any of you that have gaming consoles, I'm sure that you, like me, make most of your purchases on like the PlayStation or Xbox store. And when you want a physical disc copy or maybe want to send a physical disc for like a present or something, you usually just go to Amazon and click and buy. So even if there is a fundamental change in the GameStop leadership, it didn't seem like it had a winning business sector. There's not a sector in the economy that really looks like GameStop is filling because even if you need some sort of brick and mortar store either for like the collection of these discs or the repair of devices, Best Buy, who's much larger and wider spread, can fill that pretty much exact same role. And so that means that there's some sort of disconnect going on between what Ryan Cohen may be able to do for the company and this tripling in GameStop's value. And these doubts caused many large institutional investors to do what we call short selling the GameStop stock. And short selling is just where an investor borrows a share of a stock to immediately sell it off. And so the idea is that then later on, they can buy the stock back and return it to the person they're borrowing it from, hopefully for a profit. And we can calculate the profit from a short position in stock as the share price when you get it minus the share price that you buy it back at minus interest. So, if GameStop was trading at $15 a share, and then you short sell it and then buy it back when it drops back down to $5 per share. You make $10 minus the, let's say, $1 interest. So a total of $9 profit. So it's pretty simple what you're doing here with short selling. You're betting on the stock's price to decline and drop dramatically. And you're hoping this is going to happen in the near term. So it's quite controversial, and it's probably the most controversial form of a short position. And the big reason for that is shorting is less frequently used in some sort of hedge strategy. So, for example, when you're long or short a call position, you're usually combining it in some sort of larger strategy. So, you may be betting on volatility in the price rather than a decline in the company's value. And so this makes quite a people upset. But as this value of GameStop's continued to rise through the second half of 2020, the short position also started to increase in size. And when we look at January of 2021, the percentage of GameStop's float sold short was 140%. And that's a lot of words here, so let's break that down. The float value is the total amount of stock that is publicly traded. So when you look at the market cap, for example, the GameStop market cap in December of 2020 was 8.19 million shares. That's different from the float value because a lot of these shares are held by institutional members. So, for example, Ryan Cohen, who, as I mentioned, had a 10% stake in GameStop, he's not every day in the stock market buying and selling it. He's holding it as the chairman of GameStop. So, the float size is different from the market cap. And out of that float size, each stock was being shorted 1.4 times. So that means that there were a lot of people that were shorting the stock and selling it to somebody else who in turn was getting that stock loaned so that they could also short sell it. So the net short position in GameStop when it was just trading around like $15 was huge. And so this meant that there was a lot of exposure because short selling is not something that is commonly done. It's a pretty popular saying that stocks only go up, whatever. But there's some truth to that, that typically stocks uh, go up. The S&P 500 averages after you adjust for interest rate like 7 or 8% a year. So there's a lot more risk when you're betting against that than for that tidal wave. And so a lot of small investors are not actually allowed to short sell because your upside potential or upside risk is limitless. And so when we're looking at the short position of GameStop, it means that we're looking at what large institutional investors are doing. And a couple of big names that you probably heard thrown around were Melvin Capital, which is an investment fund. And the largest shareholders of Melvin Capital were Citadel and Point72, that were both hedge funds. And it's unclear how much of Melvin Capital's position in GameStop what actually was. However, if there was any sort of hedging done, it was extremely minimal, and that is pretty clearly shown by the consequences of the short squeeze that we're going to be talking about in a sec, because this is now when the real craziness starts from GameStop. And what ended up happening was that in mid to late January, Redditors started to realize what was going on in the short market for GameStop because short position values and the percent of float are actually publicly available information. So even though we don't know who the institutions were, we knew what the aggregate position was, and we knew at all times. And since short selling is almost exclusively done by these large institutions like Melvin Capital, we knew that there was a huge short position specifically concentrated in these large exposed investment funds that probably did a lot of it on margin. And so these Redditors got into specifically the Wall Street Bet subreddit and started to collaborate to try what we call a short squeeze. And a short squeeze is just when an underlying asset's value approaches an extremely high level. So short sellers have to close their position either by force through a margin call or by choice because they want to limit the losses from their short position. But by doing so, they have to actually purchase the stock back, which means that we're going to see a sudden surge in the increase of demand for the stock, which pumps the price of the stock up even further, and meaning the second movers to close their short position lose even more money. And so, what these day traders realized is that by causing a short squeeze on GameStop, they could very quickly make significant returns on GameStop, since we're talking about 140% of the float all trying to be simultaneously closed off. And so this was the primary original objective of everything that happened with GameStop. It had nothing with, sending it to the moon or whatever. It was a purely financial decision to try and invoke this short squeeze. But to incentivize investors on Reddit who were kind of on the fence, since the short squeeze would almost exclusively impact large hedge funds and institutional bears, this enticed many people that may either not completely understand what a short squeeze is, or maybe not actually believe that GameStop is worth $15 a share, to actually start investing aggressively. And that's what we saw first in early mid January with like January 13th and 14th, and then the second bigger wave starting on January 21st. And January 13th was the first big day of price moves with GameStop. So we saw on January 13th, a 71% increase in its price. And then on January 14th, we saw 117%. And this started to set off alarm bells in some of these institutional investors. But believe it or not, the net short float position on the 13th was actually only 114%. And so you would think that this caused the short squeeze. Well, it actually did not. It increased when you go from January 13th to 21st to the 140% number, because these institutional investors, they try to double down. They're like, there's no way that GameStop is worth $50 a share. We didn't think it was worth 10, let alone 50. And so we need to short this because eventually people are going to, stop and jump off this fad, and we're going to get GameStop back down to normal price levels. So they saw it as an opportunity to very cheaply bet against GameStop. But then January 21st is when the market really lost control of what was going on. And it was also the first day the short squeeze really hit the mainstream news. When, in doing so, it introduced a third group of investors who were investing for GameStop, who I like to call the FOMO investors, the fear of missing out investors. And this includes me in this group, where everybody realized what was going on, that the short squeeze was occurring, and even a lot of people didn't understand what a short squeeze was. They just had their buddy tell them, hey, if you invest in GameStop, you can get a lot of money really quick because we're, sending it to the moon. And this meant we had three completely different investor groups all trying to buy GameStop stock. You had the original short squeeze drivers who really understand the fundamentals of what they're trying to do and why it's such a cheeky move. Institutional opponents who just heard that they could bring down Melvin Capital and others, and then the FOMO and meme investors, all working together in the last full week of January, which led to the 21st, 22nd, 25th, 26th, and 27th, all seeing these massive gains until we got up to $350 a share on a stock that realistically should be valued at like $50 a share, or $10 a share, sorry. And this happened to be the straw that broke the elephant's back. As GameStop continued to surge, these institutional investors, they realized they were fighting a losing battle and had huge margin calls because they were taking a lot of these positions on margin. So if we look at the numbers a little bit, by January 28th, Melvin Capital lost 50% of its capital, or $4.5 billion in assets, before or it could finally completely close out its GameStop position. And as I mentioned, its largest investors were the Citadel and Point72, some pretty aggressive hedge funds. Additionally, D1 Capital lost $4 billion, which was 20% of its capital. And then pretty famous is Citron Research, which is just an institutional short fund that just aggressively shorts everything it can do and considers itself to be a little bit of a patron of the economy because it roots out mispricing and, in particular, fraud. It lost 100% of its asset value, causing it to announce that it would stop shorting in the future, which was one of the most significant announcements that kind of went under the radar through this entire thing. And so at this point, the percent short of the free float dropped to 33%, and most large investors completely closed out their GameStop position. So a lot of this 33% ended up actually being new smaller investor funds realizing that GameStop pragmatically can never stay at $350 a share forever. That being said, for those that uh, thought that they were taking down the industry, there were some large institutional investors that gained significantly from this. So, for example, BlackRock, which is the largest asset manager in the world, has a 13% stake in GameStop. So, as you can imagine, they were quite upset. Mudrick Capital held all of or a majority of AMC's debt, and also on top of that had call options on the AMC stock, which was all brought in with this huge short squeeze momentum because AMC at the time was the second most shorted stock. It had $300 million in profit from AMC going up and being able to pay off all of its debt. Morgan Stanley has a subsidiary mutual fund called Morgan Stanley Institutional Inception that holds 3% of GameStop stock. It gained, and then notoriously, the Church of Jesus Christ of Latter-day Saints held 0.5% of GameStop stock, and that they registered a 900% profit on its meme share positions. So, before we close out, I also want to take a note because this was pretty hotly contested, if you remember back to January, when, in the height of all this, Robinhood, Webull, and other trading platforms limited GameStop trading. So this was arguably the most contentious pop culture moment of the short squeeze. And on January 28th, Robinhood, Webull, TD Ameritrade, and pretty much every other investing platform all sequentially announced that they were going to put limits or completely prevent the purchasing of GameStop shares. And this was viewed as market fixing to give institutions time to offload their positions before the GameStop surge continued to happen. And this had everybody from Donald Trump Jr. to Elizabeth Warren and AOC, Bernie Sanders, Ted Cruz. We're talking all over the political spectrum, extremely upset at these institutional investors, all with this idea that it was market fixing. But in reality, it was actually quite a bit more complicated, at least with the justification that all of these investing platforms gave. So, first, a couple of definitions. A clearinghouse is just a financial institution that validates and finalizes financial transactions. So, after a trade occurs on like the New York Stock Exchange, that's not the end of it. It is first sent to a clearinghouse for processing. And these clearinghouses, they don't do it immediately. Usually they lump in large amounts of like net positions in a day together so that they don't have to keep up with like high frequency trades and stuff. Additionally, collateral, you should know, is a guarantee that is posted in the event of bankruptcy before the finish of a financial transaction. And when these clearinghouses approve transactions, they temporarily hold on to the assets that are traded, and in doing so, they require collateral for the trades to go through them. So, specifically, the clearinghouse that we're referring to in this instance is the Depository Trust and Clearing Corporation, so DTCC. Um, and when you invest in like Robinhood or whatever financial institution and platform you trade through, they're the ones that actually entered into the trade on the stock exchange for you. It's not you actually, you're not actually entering into the New York Stock Exchange trading platform. And so that means that since it takes a couple of days for the DTCC to clear any transaction that you make, they're going to hold that stock for it. It is usually 2 days. And in doing so, since they have to hold on to that stock, they require collateral. and that money does not change hands until the transaction is improved, at which time the collateral is removed. And this is also, as a side note, why you can't withdraw your money after, like sell a stock, is because you don't actually have it until the DTCC clears it. And the DTCC is just trying to limit its risk by holding on to stock for an individual that then may go bankrupt before they can pay off that transaction, at which point the DTCC is legally liable to guarantee the transaction, so they would have to pay the rest of the stock. And so, in doing so, they require some collateral. And the collateral that is required to be posted is formula based. It's usually about 10%, but it depends on A, market situations, B, whether the position was bought on margin or not, and C, the volatility of the stock that is being traded. And as you can imagine, in January of 2021, the volatility of GameStop was just at unheard of levels, which meant, and on top of it, a lot of these investors were buying GameStop on margin. If you went on Robinhood, a lot of you probably at least took a peek at GameStop. And for those of you that did, it may have been enticing to do so, either with cash that you had in your account or through margin. Um, but the problem is that the collateral requirements on GameStop went through the roof because of these problems. And at one point, the DTCC was demanding up to like 60 or 70% of the stock position as collateral. So if you think about the fact that GameStop suddenly surged to $300 a share, then you add in that there were like 2 billion shares being traded a day. We're talking about huge amounts of collateral being posted. And this was completely abnormal and never seen before, never even fathomed before. So none of these investment platforms that are in charge of actually completing the transaction for you had the reserves necessary to post for the collateral requirements. And so what they claim is the reason why they limited your trading was so that they could get the time to borrow all the cash necessary to post the collateral that was required by the DTCC to continue all these meme stock transactions. But in the aftermath, first, as you may know, Robinhood is being sued in multiple states in class action lawsuits for limiting the selling of or the buying of GameStop stock. And I'm sure that we're going to see Webull and other platforms get lumped into this as well. Additionally, the SEC is imposing new requirements and guidance on how to raise capital during times of extreme volatility to try and avoid this situation with platforms limiting the buying and selling of stock. Also, the SEC, on the flip side, is directing its gaze at Redditors for possible price fixing and insider trading because there was certainly some coordinated movement on Reddit, even if each decision was individual and there was no necessarily inside information, the SEC still is trying to figure out whether we can define this as price fixing. Also, senators have introduced legislation to introduce a transaction tax on all financial activity to limit speculative investing. Additionally, there are a couple several moral and ethical questions. First, as we mentioned, since the SEC is investigating it, we need to ask ourselves what really is insider trading. Is insider trading just using illegally obtained information or making information that is not trading, making trades off of information that is not publicly available to everyone? Or is it just coordinating the market to go a certain direction? And is that considered illegal? Additionally, at this point, when we see GameStop, which is still trading at like $200 a share, what really is equity? Because nobody in its wildest dreams believes that GameStop is actually worth that much. Um, and so the big question is like, is specifically the GameStop stock actually being viewed as ownership in GameStop anymore, or is it just a storage of value and an opportunity to meme? And if so, what does that mean for other stocks on the stock market in the future? Additionally, is short selling morally and ethically legal? Is it okay to bet against companies, even if you're doing it because you recognize and want to expose allegations of like fraud and etc.? Additionally, should this be limited in the future? Should we have better breaks either on the quantity of the short position or on the quantity that a stock can go in one direction, especially when it's not tied to anything actually in the market. Then finally, should the SEC start to regulate Reddit content? Does what happened on Reddit to cause all of this necessitate further regulation to limit the ability for the market to coordinate? Because another like underlying theme with this was that these institutions never used to have to deal with such a big problem, but through the rise of like Robinhood and commissionless trading to reduce transaction costs, lower and middle class individuals have drastically increased their purchasing power. And this kind of showed the world just how much of the stock market is now owned by day traders as opposed to large institutional investors, especially as these institutional investors run to derivatives and other financial instruments that can allow them to enter more flexible or murky transactions. So, but that's all I have on GameStop. If you have any questions, let me know. Otherwise, I hope you enjoyed this video.